Ever wondered if all risk levels are created equal? Specifically, when you're navigating the world of automated investing, like with Wealthsimple, does moderate for one person truly mirror moderate for another? It's a fascinating question, and one that gets to the heart of how these platforms assess and manage your money. We all want to grow our wealth, but understanding the nuances of risk, especially when it's being calculated by an algorithm, is absolutely crucial. Think about it. You sign up, answer a few questions about your financial goals, your comfort with market fluctuations, and your timeline. Then, boom, Wealthsimple assigns you a risk level, usually on a scale of 1 to 10. A lower number means more conservative, more bonds, less volatility. A higher number means more aggressive, more stocks, more potential for growth, but also more potential for dips. It seems straightforward enough, right? But what if your moderate risk tolerance, based on your life experiences and financial situation, is interpreted differently by Wealthsimple's algorithm than someone else's? Are there hidden layers, subtle distinctions, or perhaps even significant variations in how these risk levels are truly implemented across different client profiles? This isn't just an academic exercise. This is about your money, your financial future, and your peace of mind. If you believe you're taking a calculated, comfortable amount of risk, but the underlying portfolio is actually more volatile than you anticipate, that could lead to sleepless nights during a market downturn, or even cause you to make rash decisions that derail your long-term plans. Conversely, if you're comfortable with more risk but are being pigeonholed into a conservative portfolio, you could be missing out on significant growth opportunities. So, let's dive deep into this. Can we truly compare Wealthsimple's risk levels from one client to another? Are the portfolios associated with a 6 risk level always identical, regardless of who's investing? Or are there subtle, personalized adjustments that make each 6 unique? This is what we're going to uncover today, dissecting the factors that influence Wealthsimple's risk assessment, examining the typical asset allocations for different risk levels, and exploring whether there's more to these numbers than meets the eye. By the end of this, you'll have a much clearer understanding of how Wealthsimple manages risk, and more importantly, how you can ensure your risk level truly aligns with your financial goals and comfort zone. First, let's understand how Wealthsimple determines your risk level. It's not just a random guess. When you onboard, you're presented with a series of questions. These questions are designed to gather information about several key areas. Your financial goals. Are you saving for retirement in 30 years, a down payment in 5 years, or a short-term goal like a vacation? Your timeline significantly impacts the appropriate level of risk. Longer time horizons generally allow for more risk, as you have more time to recover from market fluctuations. Your investment horizon. This ties directly to your goals. A shorter horizon typically means a more conservative approach is prudent, as you don't have the luxury of waiting out extended market downturns. Your experience with investing. Have you invested before? Are you familiar with market volatility? Your past experience can influence your comfort level with risk. Someone who's been through a few market corrections might have a different perspective than someone new to investing. Your comfort with market fluctuations. This is often gauged through hypothetical scenarios. If your portfolio dropped by X%, how would you react? These questions are crucial for assessing your psychological tolerance for risk. It's one thing to say you're comfortable with risk, and another to live through a 20% decline in your portfolio. Your income and savings. While not directly determining your risk tolerance, your financial capacity to absorb losses can indirectly influence the recommended risk level. Someone with a stable, high income and significant emergency savings might be able to take on more risk than someone with less financial flexibility. Based on your answers to these questions, Wealthsimple's algorithm assigns you a risk score, typically from 1 to 10. This score then dictates the composition of your portfolio. A higher score means a higher allocation to equities, stocks, which are generally more volatile but offer higher potential returns over the long term. A lower score means a higher allocation to fixed income, bonds, and cash, which are less volatile but offer lower returns. Now, here's where the comparison question truly comes into play. If two different individuals both answer these questions and are assigned a risk level of, say, 6, will their portfolios be identical? This is the million-dollar question. And the answer, while nuanced, is generally yes. For the most part, the asset allocation for a given risk level is standardized across clients. Wealthsimple, like most robo-advisors, operates on a principle of efficiency and scalability. They build model portfolios for each risk level. So, a risk level 6 portfolio will have a predefined target allocation, for example, 60% equities and 40% fixed income. This allocation will be consistent whether you're a 25-year-old student saving for retirement or a 50-year-old professional saving for a new home. The underlying philosophy is that the algorithm, based on your answers, has determined that a 6 risk level is appropriate for your specific profile, and therefore, the standardized 6 portfolio is what you receive. This standardization is a core benefit of robo-advisors. It allows them to offer low fees and efficient management. They don't individually customize every portfolio beyond the initial risk assessment. Your 6 is the same 6 as someone else's 6 in terms of target asset allocation. However, there are some subtle points to consider that might make it feel like portfolios are different, even if the underlying asset allocation is the same. Time horizon and rebalancing. While the target allocation for a risk level is consistent, the actual allocation can drift over time due to market movements. Wealthsimple employs automatic rebalancing to bring your portfolio back to its target weights. However, the timing and frequency of these rebalances might slightly vary depending on market conditions and the specific rebalancing thresholds set by Wealthsimple. So, 2-6 portfolios might look slightly different at any given snapshot in time if one was just rebalanced and the other hasn't hit its rebalancing trigger yet. This is a temporary deviation, not a fundamental difference in risk level. Specific ETFs within asset classes, while the percentage allocation to equities and fixed income will be the same, the specific exchange-traded funds, ETFs, that Wealthsimple uses to achieve those allocations might vary slightly over time. For example, they might switch from one S&P 500 ETF to another if they find one with lower fees or better liquidity. These are minor changes at the sub-asset class level and generally don't impact the overall risk profile of the portfolio. They are designed to optimize the portfolio for efficiency and cost, not to alter the risk level for specific clients. With that said, thanks for watching and until next time.